Imagine someone changed this number just 0.25%. It sounds tiny, almost meaningless, and yet a move this small can shift trillions of dollars in a matter of minutes. Somehow, it can reach a couple trying to buy their first home, a business owner deciding whether to hire, and the United States government itself. And here is where things get strange. December 18th, 2024, the Federal Reserve cut interest rate by 0.25%. That sounds like good news. Lower rates, cheaper borrowing, higher stock prices, maybe lower mortgages. Instead, stocks fall sharply, Treasury yield rises, the dollar strengthens, and the mortgage rate do not suddenly fall. Some actually move higher. So how can the Fed cut the interest rate while some borrowing costs rise? The answer begins with the biggest misconception about the Federal Reserve. The Fed does not directly control your mortgage rate. Its direct control is much narrower. It controls the starting condition at the very short end of the financial system. And from there, the effects spread outwards. So rather than memorizing a pile of financial vocabulary, we're going to follow the money from the source. We'll start with the tiny overnight market the Fed actually influences. Then we'll follow that change into banks, bond markets, mortgage, stock, business decisions, jobs, and eventually inflation. And we'll answer the mystery we started with. How can a tiny change at the source affect almost everything downstream? By the end, terms like federal funds rate, IORB, SOFR, Treasury yield, yield curve, core PCE, discount rate, and dot plot should no longer sound like a foreign language. More importantly, you understand why each one exists and how they connect. This is the whole map. Don't worry about understanding it yet. By the end, every branch will make sense. If you are interested in getting my videos in advance, please consider joining the membership. Research Tier member can also download infographics from my videos. And this is for educational purposes, not financial advice. My goal is to show you how this one tiny rate at the Federal Reserve spread through the entire system, eventually reaching markets, businesses, jobs, and inflation. So let's start at the source. When people say, the Fed changed interest rates, which interest rate are they actually talking about? Here's the first surprise. There's no single interest rate. There are dozens. Buy a house, you pay a mortgage rate. Carry a credit card balance, you pay a completely different rate. Put money in a saving account, the bank may pay you another rate. Businesses borrow at their own rate. The US government borrow at Treasury rates. And financial institutions lend to one another at other rates. These rates are connected, but they are not identical. They don't always move at the same speed. They don't always move by the same amount. And sometimes, they even move in opposite directions. So when the headline says, the Fed raised interest rate, which rate actually changed? The Fed focused on a very short-term market rate. The official name is the federal funds rate. In plain English, it's an interest rate on certain overnight loans of reserve money between financial institutions. But what exactly is reserve money? For now, just think of reserve as special electronic money banks hold at the Federal Reserve. We'll explain this properly in the next act. The important word right now is overnight. Not 30 years, not 1 year, not 1 month, not even 1 week. Borrow tonight, repay tomorrow. Picture the end of a business day. One institution finishes with more reserve money than it wants. Another institution wants more. So the first institution lends some reserve to the second overnight. The next day, the money comes back, plus a little interest. That market interest rate is the federal funds rate. More precisely, the Federal Reserve announced a target range for the federal funds rate and used its monetary policy tools to keep the actual market rate inside that range. But you will probably never borrow at this rate. Your mortgage does not directly use it. Your car loan does not directly use it. Your credit card does not directly use it. So why does everyone care? Because this is not really a consumer rate. It's part of a wholesale financial system. Think about Costco. Costco might sell bottled water in giant packages. Your corner store sells one bottle. Same basic product, different customer, different scale, therefore different price. Money works similarly. The federal funds rate sits near the wholesale end of the financial system. Your mortgage and credit card sit much further downstream. Between these 2 points, banks and market will add things like time, risk, inflation expectations, and their own required return. So the federal funds rate does not simply become your mortgage rate, but it helps establish the starting conditions from which many other financial decisions are made. And this gives us our main visual for the video. Imagine a tiny spring at the top of the mountain. It does not look powerful. It's just a trickle. But the spring feeds the stream. The stream becomes a river, and eventually the water reaches homes, businesses, factories, farms, and entire cities downstream. The Fed operates near that spring, change the price of a very short-term money near the source, and banks and market begin adjusting. Eventually, those changes can reach business loans, treasury yield, mortgages, credit card, savings rate, stock prices, and the wider economy. But now we have a new problem. We know which rate the Fed is targeting. We still don't know how the Fed actually make that rate move. There isn't a giant lever in the Federal Reserve marked interest rate. So what does it actually do? The answer depends on when you are asking. Before the 2008 financial crisis, the Fed controlled overnight rate mainly by changing how scarce reserve money was. Today, it operates differently. It largely changed where reserve money can earn. But before either system makes sense, we need to understand reserves. You and I can hold money in accounts at commercial banks. Commercial banks can hold money in accounts at the Federal Reserve. The balances in those Fed accounts are called bank reserves. They are real money, just a special form of electronic central bank money used inside the banking system. And banks use reserves to settle payments with one another. Suppose someone at Bank A sent $100 to someone at Bank B. To us, it looks simple. One checking account goes down by $100, another goes up by $100. But behind the scenes, the two banks also have to settle with each other. Reserve money moves from Bank A's account at the Fed to Bank B's account at the Fed. So reserves are not fake dollars. They are the electronic dollars banks use with one another. And now we can understand something else people often hear. The Fed prints money. Usually that does not mean somebody is literally printing stacks of paper currency. The Fed can create new reserve money electronically. To see how, we need one more thing: Treasury securities. And before we continue, we have to separate two institutions people constantly mix up. The US Treasury and the Federal Reserve are not the same institution. The Treasury is part of the federal government that borrows money. When the government needs financing, the Treasury issues Treasury bills, notes, and bonds. A Treasury security is basically a promise from the US government. Lend us money today, and we'll repay you later, with interest. Banks can own treasuries. Pension fund can own treasuries. Foreign government can own them. You can own them. Now the Federal Reserve entered the story. The Fed can buy treasury securities that are already circulating in financial markets. Suppose the Fed buys a $100 treasury security from a bank. The bank gives the Fed the treasury, and the Fed credits the bank's reserve account by $100. That electronic reserve balance is a payment. The bank has exchanged one asset, a treasury security, for another asset, $100 of reserve money. If the Fed buys the treasury from an investor, rather than directly from a bank, there's one extra step. The investor receives a normal bank deposit, and the investor's bank receives matching reserve at the Fed. Either way, the banking system ends up with more reserve money. So to remember the distinction, the Treasury creates the government security. The Fed can create reserve money used to buy it. Now we can answer the question we actually care about. Why would buying a Treasury security change interest rates? Picture all the reserve money in the banking system as water in a swimming pool. Before 2008, the Fed kept that money relatively shallow. Reserves were scarce. Suppose the Fed wanted the federal funds rate to fall. It could buy Treasury securities. That created additional reserves. More water entered the pool. Now more institutions had extra reserve money available to lend overnight. And before 2008, those extra reserves generally did not earn interest just sitting at the Fed. So institutions had an incentive to lend them. Now imagine several lenders competing for the same borrower. One says, I'll lend at 5%. Another says 4.9%. Another one says 4.8%. More money is available to lend. Borrowers have more choices. Lenders compete by offering lower rates. So the federal funds rates fall. And if the Fed wants rates higher, they simply reverse the process. Sell securities. Remove reserves. Reduce the amount of reserve money in the pool. Now borrowers have to compete harder for the available money. One says, I'll pay 5%. Another says 5.1%. The other one says 5.2%. In this case, borrowers compete. The price of borrowing rises. And that price is the interest rate. The official name is open market operations. In plain English, it is the Fed buying or selling securities to change the amount of reserve money in the system. For decades, this worked really well. Add some reserve, overnight rates move down. Remove some, overnight rates move up. And then, 2008 happened. During the financial crisis, the Fed bought enormous amount of treasury securities and mortgage-backed securities. The official name is quantitative easing, QE. In plain English, it's the large-scale asset purchases paid for with newly created reserve money. Think of opening every faucet at once. The pool didn't just fill, it became enormous. Trillions of dollars of reserve money entered the banking system. And this raises a natural question. Where did the Fed get the money? It did not need to collect taxes first. It was not drawing down some giant savings account. It created reserve money electronically as it purchased the assets. In that narrow accounting sense, the Fed cannot run out of money in the same way a household or a company can. But it still have a constraint. Its constraint is not simply do we have any dollars left. Its constraint is what happens to the economy if we create more. Too much monetary stimulus can contribute to inflation, distort financial markets, and damage confidence. So the limit is economic, not the bank balance. Still, QE created another problem. It broke the old method of fine-tuning overnight rates. Before QE, reserves were scarce. A small change in supply mattered. After QE, reserves were abandoned. Trying to move overnight rate by adding a small amount of reserves became like trying to change the level of the Pacific Ocean with one bucket. The Fed needed a new mechanism. That is why we now need to introduce another rate, because the Fed needed another tool. Imagine you are a bank with actual reserve money. You have two choices. Option 1, leave the reserve in your bank at the Fed overnight, and the Fed pays you 4%. Option 2, lend the money somewhere else for 3.8%. So why take additional effort or risk for 3.8% when you can earn 4% at the Fed? You probably wouldn't. And that is the basic logic behind this new mechanism called interest on reserve balances, or IORB in short. In plain English, it is the interest eligible banks and other depository institutions earn on reserve balances held at the Federal Reserve. Think of the Fed saying, leave your reserve money here, and I'll pay you this rate. If IORB is 4%, a bank will generally be reluctant to lend those reserves somewhere else for much less. So other borrowers have to offer competitive returns, and that helps pull overnight market rate toward the Fed's desired level. Notice what the Fed is doing. It isn't ordering every institution you must change 4%. Instead, it changes the alternative available to them. Then institutions adjust their own behavior. The Fed works through incentives, not commands. IORB isn't a perfectly rigid floor underneath every overnight rate. Not every institution in every short-term market can earn IORB directly. So it's better to think of IORB as a very powerful anchor. Raise the anchor, short-term rates tend to rise around it. Lower the anchor, short-term rates tend to fall. Now we understand the Fed's administrated rate. But there's still an obvious question. IORB is a rate paid inside the Fed's own system. What about the huge amount of overnight lending happening outside the Fed? To see whether the anchor is spreading into the wider market, we need a market rate. And that is why SOFR matters. The official name is Secure Overnight Financing Rate. Imagine one large institution needs cash overnight. Another institution agrees to lend it the money, but the borrower provides something valuable as protection. Usually it's the US Treasury securities. If the borrower fails to repay, the lender has the other party's US Treasury securities. That protection is called collateral. So SOFR is essentially a market measure of the cost of borrowing cash overnight when the borrowing is secured by Treasury collateral. IORB and SOFR are different. IORB is what eligible bank can earn on reserve money held at the Fed. SOFR is the market rate for overnight cash borrowing backed by treasuries. So why did we introduce SOFR immediately after IORB? Because they live in the same short-term money market ecosystem. Large institutions constantly compare opportunities between IORB and SOFR. If one overnight market offers much better return than the other, money starts moving. That competition keeps these short-term rates, IORB and SOFR, related to one another. So when the Fed changes return available near the center of the system, other overnight market rates tend to adjust too. And SOFR matters beyond the overnight market because it's used as a reference rate. A reference rate is simply a starting number written into another financial contract like business loans. A business loan might say SOFR plus 2%. If SOFR is 4%, the loan rate is then around 6%. And this is our first direct example of an overnight market rate appearing further downstream. Some history here. Before SOFR, for years, many financial contracts instead used LIBOR. LIBOR depended heavily on estimates submitted by banks, not collaterals like US Treasury securities. And then there were manipulation scandals around LIBOR. which then destroyed confidence in the LIBOR benchmark. Financial markets moved toward alternatives such as SOFR, which is based much more heavily on actual transactions. You do not need to remember the history. The important point is, the Fed anchors the very short end on IORB. Market rates like SOFR adjust around that environment, and those short-term rates can then appear directly in loans and other financial contracts. Now we finally know enough to look at the real map. Let's bring back the picture from the beginning, but now we can make it more precise. And there's one thing I want to make very clear. The financial system is not one straight chain. The river branches. At the source is Fed policy. The Fed uses administered rates such as IORB and other tools to keep the federal funds rate within the target range. That anchors the very short end of the financial system. Then the river split into 3 main branches. We'll go through each branch in detail, but here's the overview. Branch 1 runs through banks and short-term lending. Overnight rates change the returns and alternatives available to banks. That affects rates on short-term and floating rate borrowing. Some loans may reference SOFR directly. Other products are tied to bank reference rates like prime. That reaches businesses and consumers relatively quickly. Branch 2 runs through the bond market. Here, the investors are not only asking what is the Fed rate today, they are asking what will rate be next year? What will inflation be? What will growth look like? Those expectations show up in Treasury yields, and Treasury yields become reference point for mortgages, corporate bonds, and other long-term borrowing. Branch 3 runs through asset prices. Treasury yields and other safe returns change alternatives available to investors. That changes discount rate, which change how stock, bond, real estate, and other assets are valued. And then all 3 branches eventually reach the real economy. Borrowing changes, investment changes, home buying changes, spending changes, hiring changes, and eventually growth and inflation respond. So if you remember nothing else from the map, remember 4 lines. The Fed anchors the short term. Banks price loans. Market price the future. Households and businesses respond later. Now let's follow each branch. Start with banks. Suppose a very safe short-term money suddenly pays around 5%. A company comes to a bank and asks for a loan. The bank has to say, why should I lend to you unless you pay me enough to compensate for the actual risk, compared with simply leaving my reserve money at the Fed and earning a safe return? That raises a starting point for consumer lending. And now another rate becomes useful. The official name is the prime rate. Why are we introducing prime? Because we have left the wholesale overnight market, and we are entering the rate banks quote to actual individual customer. Prime is a reference rate banks use when pricing loans to some of their strongest borrowers, say companies like Apple, Microsoft, or J&J. Think of it as the bank's VIP starting rate. A strong business borrower may get a rate near prime. A riskier borrower pays prime plus something extra. Many credit cards are also priced as prime plus a large spread. Prime tends to move very closely with the Fed's policy rate. When the Fed moves its target range, major banks usually adjust prime quickly. So this is one of the shorter paths through the system. Fed policy changes, short-term rate move, prime moves, and some floating rate loans and credit card rates move soon afterwards. And remember SOFR? Here is where it reappears. Many business loans do not use prime at all. They may be written directly as SOFR plus a spread. So SOFR wasn't an isolated vocabulary term. It's one of the bridges connecting the overnight market rate to real-world financing. That is the short-term branch. But Sarah's mortgage is different. Sarah isn't borrowing overnight. She's borrowing for decades. So we need a rate that tells us what markets charge for time. That is why we now leave prime and SOFR and move to the bond market branch. Most people think the stock market sits at the center of the finance. It's what we see on television. Flashing prices, green arrows, red arrows, breaking news banners. But underneath the enormous part of the financial system is the bond market. A bond is simply a loan that can be bought and sold. You lend money to a company, a city, or government. The borrower promises to pay interest over time and eventually return your money after a fixed period. The US government borrows through Treasury securities. And once those Treasury trade in markets, investors constantly decide what return is attractive enough to own them. That brings us naturally to Treasury yield, which is the market return on lending money to the US government for a particular period of time. Why do we need Treasury yields now? Because federal funds and SOFR describe extremely short-term money. Treasuries let us see what the market thinks money should cost over 3 months, 2 years, 10 years, 30 years. And the longer the time period, the more future matters. If I'm lending money for 10 years, I don't only care what the Fed is doing tonight. I care about future Fed rates, future inflation, future economic growth, and what other opportunities might become available. So here's the critical distinction. The Fed anchors today's very short-term rate. The bond market price what it thinks short-term rate and inflation will look like in the future. It is based on investors' expectations. Suppose the Fed policy rate is around 4% today. Investors become convinced inflation will stay high, and the Fed will keep rates high for years. Longer-term Treasury yields may rise. But now suppose investors think the economy is weakening, inflation is falling, and the Fed will cut aggressively next year. Longer-term Treasury yield can start falling today, even while the Fed hasn't cut yet. That is why Treasury yield do not simply copy the federal funds rate. The short end is heavily anchored by current Fed policy. The longer end contains much more information about the expected future. But that raises another question. If investors expect future short-term rate to average, say, 3%, why wouldn't a 10-year Treasury yield simply equal 3%? Because lending for a long time introduces another uncertainty. And anytime there's uncertainty, investors will want actual returns to compensate for that risk. And now we need another concept. The official name is term premium, which is the exact compensation investors may demand for locking money away for a long period and taking uncertainty about the future. Over 10 or 30 years, inflation may surprise you. Interest rate may change. Economic conditions can change. Your money may be stuck earning an unattractive rate, while new investments offer more. So a long-term yield can be thought of very roughly as containing expectation of future short-term rates, plus compensation for holding long-term risk. That helps explain why the whole Treasury market does not move in perfect lockstep. And now we can finally zoom in on the Treasury maturity Sarah cares about most. The official name is the 10-year Treasury yield. It is the market return on lending money to the US government for 10 years. Why introduce the 10 years specifically? Because Sarah wants a long-term mortgage, and mortgage markets are much more closely connected to longer-term bond yield than to one overnight Fed rate. A 30-year mortgage doesn't literally equal to the 10-year Treasury yield. Mortgages are priced in the mortgage-backed security market, and they have their own risks and costs. But the 10-year Treasury is a very useful benchmark for the long-term rate environment. Because if investors can earn, say, 4.5% by lending to the US government, a mortgage investor is not going to happily accept 4.5% for lending to homeowners with more complexity and risk. The mortgage has to offer something extra. And now we need one more idea, the spread. A spread is the actual return investors demand above a safer benchmark. One common kind is called a credit spread, extra compensation for lending to a borrower who might be less certain to repay than the US government. But mortgages contain more than just credit risk. There's also prepayment risk. Homeowners can refinance. Mortgage servicing costs money. Mortgage-backed securities have their own liquidity and market risks. So mortgage rates generally sit above Treasury yields, and the size of that gap can change. This gives us Sarah's mortgage in much more realistic form. Long-term market rates plus actual compensation for mortgage-specific risks and costs. It is not Fed funds rates plus 2%. That is why Sarah's mortgage can behave very differently from the Fed's overnight rate. And we can now solve something that seemed impossible at the beginning. The Fed can cut its overnight rate, while the 10-year Treasury yield rises. If investors become simultaneously more worried about future inflation, or believe future Fed rates will remain higher than they previously expected, long-term yields can rise. And if long-term yields rise, mortgage rates can stay high or move higher too. The Fed moved the spring, but Sarah is drinking water much further downstream. So at this point, we have overnight rates, 2-year Treasuries, 10-year Treasuries, 30-year Treasuries. Rather than look at each point separately, finance has a simple way to put them on one chart, the yield curve. It is a chart of interest rates across different maturities. Normally, longer-term yields are often higher than shorter-term yields, because lending for longer involves more uncertainty, so the curve slopes upwards. But sometimes, the opposite happens. Short-term rates rise above longer-term rates. It is called yield curve inversion. Why would that happen? One common reason is that the Fed has pushed short-term rates high today, while investors believe those high rates will not last. They expect slower growth, lower inflation, and future Fed cuts. So longer-term yields can sit below short-term yields. An inverted yield curve is not a magic recession detector, but it tells you something important. The market believes the future rate environment may look very different from today. And now the long-term branch is complete. But rates don't stop with financial markets. Eventually, they change real decisions. Imagine a company considering a 100 million factory. The project is expected to generate an 8% return. If the company can finance the project at 5%, the numbers may work. Build a factory, order the machines, hire construction workers, add employees. But suppose financing costs 9%. The factory hasn't changed. The machines hasn't changed. The customers hasn't changed. But the financing changed. Now the 8% expected return will not justify the cost of borrowing at 9%. So the company waits. The equipment order disappears. The construction contract disappears. The hiring plan shrinks. That is how an abstract financial number turns into something very real. An interest rate changes. A spreadsheet changes. A business decision changes. And eventually, someone's life changes. Now let's stop for a second and bring the map back. The Fed anchors the short end. One branch runs through prime, SOFR-linked loans, credit cards, and short-term business borrowing. Another branch runs through expectations, Treasury yields, mortgage markets, and long-term borrowing. And those branches reach households and businesses. But there is still one huge piece missing from the map: stocks. Stocks can react in seconds, before a single factory is cancelled, before Sarah changes her home buying plan, before anyone loses a job. Why? Because interest rates do something else. They change the value of the future itself. This brings us to the third branch on the map: how this can affect asset prices. Imagine a company wake up tomorrow with exactly the same product, customer, employees, factories, and technology that it had yesterday. Then the Fed speaks, and the stock dropped 10%. How can the money suddenly be worth less when almost nothing about the company changed? Because the stock price is not just a report card on the present. It reflects what investors are willing to pay today for profits they expect in the future. And the interest rates change what future money is worth today. To understand that, we need one foundation idea. Suppose I offer you $100 today, or $100 10 years from now. Which would you choose? Probably the $100 today. Why? Because today's money can work. You can spend it, you can save it, invest it, earn a return so that in 10 years, it could be worth more than $100. So money far in the future is worth less than the same amount today. This is called present value. It is what a future payment is worth today. But that creates another question. How much less should future money be worth today? Well, to calculate that, we need a rate. That money is the discount rate. It's the rate used to translate future money back into today's value. The higher discount rate, the less future money is worth today. That is why I like the metaphor. Interest rates are like financial gravity. When rates are low, gravity is weak. Profits 10 years away can still support a high valuation today. When rates rise, gravity gets stronger. Distant profits are pulled down more heavily in present value. And now we can see why different companies react differently. Imagine company A, a mature business, strong profits today, maybe it paid dividends. Much of its value comes from cash arriving relatively soon. Company B is a growth company. Maybe investors think it will become enormous. But most of those expected profits are many years away, like many tech or AI stocks. Which company is more sensitive to financial gravity? It is company B. Because company B's profit is far into the future, and the further away the profits, the more sensitive their present value is to discount rate. That's one reason growth stocks can move so dramatically when interest rates change. But we still haven't answered one question. Where does the discount rate itself come from? In finance, investors are always thinking about this in their mind. If I don't invest in this, where else can I invest safely? And that rate will be a good reference point. And that brings the Treasury market back into the story. The risk-free rate. It is a return available on investment, treated as extremely safe in financial models. Well, nothing in this world is perfectly risk-free, but US Treasury securities are considered safe enough and commonly used as the benchmark. Suppose Treasuries pay 1%. A risky stock may look attractive. Now Treasury pay 5%. Suddenly, the investor has another option. Why take major stock market risk when a much safer investment already pay a meaningful return? That leads directly to the next concept. A risky stock must offer something extra to justify the risk. The official name is called equity risk premium. It is the additional return investors expect for owning stocks instead of safer assets. So now the discount rate logic becomes easier to see. Start with the safe return. then add compensation for taking more risk. If the safe starting point rises, the required return on risky asset can rise too. And if expected company profits hasn't changed, one way for investors to earn a higher future return is for the stock's price today to fall. There's a simpler everyday phrase for the same intuition: opportunity cost. It is what you give up by choosing one option over another. When safe bonds pay almost nothing, you don't give up much by avoiding them. But if the safe bond pays 5%, owning a risky stock means giving up a much more attractive safe alternative. So stocks face stronger competition from safe assets. But interest rates are not magic. A company can still rise in a high-rate environment if its business improves enough. Think of a rocket. Higher rates strengthen gravity. But if the rocket engine becomes dramatically more powerful, the rocket can still climb. If profits grow much faster than anyone expected, the improvement can outweigh the pressure from higher rates. So rates up, stock down, it's a tendency. It's not a law. And now, there's one last surprise in this branch. You may think, fine, stocks are risky, but treasuries are safe. Safe from what? Treasuries can be extremely safe from default, while still losing market value. Suppose you bought a bond paying 2%. Tomorrow a new bond pays 5%. Why would someone pay full price for your old 2% bond when they can buy a new one paying 5%? To make your old bond competitive, its market price has to fall. So rates up, existing bond price down. That is why government bonds can have terrible market years, even though the government keeps making its payment. Now look at what higher rates can do. Mortgage rates can rise. Business financing can become more expensive. Existing bonds can fall. Stock valuation can fall. Factories can get cancelled. Hiring can slow. Which raises the obvious question: why would the Fed ever do this for people to suffer? Because sometimes slowing things down is exactly the point. Imagine a car going down a steep mountain road. If it's moving at a safe speed, you leave it alone. But if the car keeps accelerating, eventually you press the brake, not because you hate the car, but because you don't want it to lose control. Interest rates are one of the Fed's main braking mechanisms, and one reason it hit the brake is inflation. Prices rising over time, so the same amount of money buys less. The Fed aims for inflation of about 2% over longer term. The problem is when inflation remains too high. To understand why that matters, we need two basic ideas: demand, how much people want to buy, and supply, how much is available to buy. Price tends to rise when demand grows faster than supply. Imagine 100 families trying to buy 20 houses. They compete. Price rise. Or imagine households suddenly spend much more, but businesses cannot increase production quickly enough. More spending is competing for the same amount of goods and services. Price rise again. So inflation is not simply too much money. A better question is, how much demand is there relative to what the economy can supply? Now we can answer, how do higher interest rates help? They make borrowing and spending less attractive. Meet David. David owns a successful restaurant. He wants to borrow $1 million to open a second restaurant. When financing is cheap, the numbers work. He signed a lease, orders ovens, pays contractors, hires 20 people, then rates rise. Same restaurant, same menu, same neighborhood, but the financing cost is much higher. David reran the spreadsheet, and maybe the expansion no longer makes sense, so he waits. One David doesn't change the economy, but millions of similar decisions do. A manufacturer delays a factory, a family postpones buying a house, a consumer keeps an old car, a company hires 50 employees instead of 100. The chain becomes higher rate, less borrowing, less investment, less hiring, and less spending, weaker demand, less pressure on prices. Eventually, inflation can cool. Notice what the Fed did not do. It didn't order the grocery store to cut prices. It didn't tell what David to charge for dinner. It changed the financial incentives, and millions of separate decisions did the rest. But there's a cost. If spending slows enough, businesses may hire fewer people. Some may lay people off. And that brings us naturally to the Fed's actual job, the dual mandate. Congress gives Fed two goals to hit: maximum employment and stable prices. The problem is that sometimes those goals pull in opposite directions. Inflation too high, higher rates may help, but it can also weaken employment. And employment rising sharply, lower rates may help, but it can also stimulate demand and add inflation pressure. So the Fed is constantly balancing two dangers, doing too little and doing too much. How does it know which danger is larger? By watching the data. And this is why the inflation terms you hear on Fed Day actually matter. The first common measure is CPI, Consumer Price Index. CPI tracks changes in prices paid by consumers across a basket of goods and services: food, rent, transportation, medical care, clothing. It's trying to answer, how much have consumer prices changed? But CPI is not the only inflation measure. And here's why we need another one. The Fed's normal 2% inflation goal is defined using PCE, the Personal Consumption Expenditures Price Index. PCE measures consumer inflation using a somewhat different methodology and adjusts more flexibly as households change what they buy. So if you hear people say, the Fed prefers PCE, that's why it matters. It's an inflation measure tied to the Fed's 2% goal. But both CPI and PCE contain categories that can be extremely volatile. Oil prices can jump because of war. Food can jump because of drought or disease. Those prices matter enormously to households. But policymakers also want to see whether inflation pressure is spreading through the rest of the economy. That is why they also examine core inflation, which is the inflation excluding food and energy. Core inflation does not mean food and energy do not matter. It gives policymakers another lens for seeing the underlying trend. And even with all this data, the Fed still has a major problem. Its decisions work with a delay. Raise rates today, and the full price on businesses and households may take months or longer. Companies won't cancel every project tomorrow morning. Families don't immediately change every purchase. Existing loans don't all reset at once. Budgets take time. Hiring plans take time. Construction takes time. Imagine driving a car where the steering responds late. You turn now, but you don't know until much later. Turn too little, you may miss a corner. Turn too much, you may end up in the ditch. This is monetary policy. The Fed has to make decisions today, based partly on what it thinks the economy will be tomorrow. And that leads to another limitation. Higher rates can reduce demand. But can they fix every reason prices rise? Can the Fed create more oil, build more houses, manufacture more chips? No. And this is where the Fed's power ends. Inflation can come from different places. Sometimes people suddenly want to buy much more. That's a demand problem. Sometimes there's suddenly less available to buy. That's a supply problem. Because these causes are different. We need different language for them. Demand shock is a sudden increase in demand. Households spend more. Businesses cannot respond fast enough. Price rise. Now compare that with supply shock. A sudden reduction in available supply. A factory closes. A war disrupts energy. A pandemic breaks shipping. A drought destroys crops. Demand may not have increased at all, but there's simply less available. Price rise anyway. And here's the Fed's problem. It can influence demand, but it cannot manufacture supply. Suppose a war can remove oil from the global market. Gas prices rise. Shipping gets more expensive. Airlines pay more. Factories pay more to move goods. What can the Fed do? It cannot drill an oil well. It cannot refine gasoline. It cannot end the war. Its main tool is still demand. It can make borrowing more expensive, reduce spending, and try to reduce pressure elsewhere in the economy. That may help overall inflation, but it doesn't create the missing oil. Same with housing. The Fed can make mortgage more expensive and reduce the number of buyers competing for homes, but it cannot build a single apartment. Same with semiconductor. It can reduce demand for electronics, but it cannot build a leading-edge fab overnight. So whenever inflation rises, don't ask only how high is inflation. Also ask, why are prices rising? Because the Fed's tool fits some causes much better than the other. But there's another thing the Fed can influence that isn't physical at all. Expectations. Imagine you own a restaurant. You believe food costs will rise another 10% next year. What do? You may raise menu prices now. Your employees believe rent and groceries will keep rising. They ask for larger raises. Your labor costs go up. You raise price again. The expectation of future inflation begins affecting inflation today. That is why economists talk about inflation expectations. It is what people believe inflation will be in the future. Businesses use those expectations when setting prices. Workers use them when negotiating wages. Investors use them when deciding what return they need. So if everyone becomes convinced inflation will stay high, their behavior can make inflation harder to control. And that means the Fed needs something beside the interest rate tool. It needs people to believe it. And that brings us to credibility. It is whether households, businesses, and market believe the Fed will actually do what it says. Suppose the Fed says, we'll bring inflation back toward 2%. The real question is, does anyone believe them? If people believe inflation will eventually stabilize, they may behave differently today. If nobody believes the Fed, controlling inflation becomes much harder. And because credibility matters, the Fed doesn't just move rates, it communicates. Which brings us directly to forward guidance. The Fed communicating how it sees the economy and how policy may evolve. Sometimes a sentence about the future can move markets more than a quarter-point rate change today. And history gives us an extreme example of why credibility matters. In the late 1970s and early 1980s, the United States had severe inflation as high as 15%. High inflation had become embedded in expectations. Businesses expected costs to keep rising. Workers expected purchasing power to keep falling. Then, Paul Volcker became Fed chair. The response was extraordinarily painful. Short-term rates rose dramatically. At points, the federal funds rate approached 20%. Borrowing became brutally expensive. Housing suffered. Business suffered. Employment rose. The economy went through deep recession. People were furious. Home builders sent pieces of lumber to the Fed in protest. Farmers brought tractors to Washington. But eventually, inflation fell, and something else changed too. People came to believe that the Federal Reserve was willing to take painful action, rather than allow inflation to spiral indefinitely. That credibility became an economic force of its own. And this gives us one of the deepest lessons in the video. The Fed's power does not come only from where it sets rates today. It also comes from how it shapes belief about tomorrow. And now, we have everything we need to solve December 18th, 2024. Because financial markets live almost entirely in that future. We just saw expectations can change how businesses and workers behave. Financial markets take the idea to another level. They react to changing expectations almost instantly. Let's return to the mystery. December 18th, 2024. The Federal Reserve cut its target range by 0.25%. The headline sounds positive. And then, stocks fall. Treasury yields rise. The dollar strengthens. At the beginning of the video, that looked backwards. Now it doesn't. Because the market do not simply react to what happened today. They constantly try to price what happens next. A stock price reflects expectations about future company profits. A bond yield reflects expectations about future rates, inflation, and risk. Currencies reflect relative expectations across countries. So a financial market is basically an enormous prediction machine. Think about a weather forecast. Tomorrow is supposed to be sunny. You plan a picnic, buy food, invite friends. Then the forecast changes. A major storm is coming. Look outside. The sky is still blue. Today's weather hasn't changed, but your behavior changes immediately because your information about tomorrow changed. Markets work the same way. They don't wait for the future to arrive. They react when the forecast changes. That means the Fed meeting actually contained two separate events. The first is the action, raise, cut, hold. The second is the message. Why did they do it? How worried are they about inflation? How worried are they about employment? How many cuts or hikes might come later? Where might rates be a year from now? And very often, the message matters more than the action. So how do investors see what the Fed thinks about the future? And that is why we now need the dot plot. It is a chart showing individual Fed officials' projections for the appropriate policy rate in future years. Each official places a dot. The dots are not promises. The economy changes, forecast changes, but together, they give markets information about how the Fed's view of the future is moving. Suppose the Fed cuts today. Sounds good. But then the dots move higher. Investors suddenly realize the Fed thinks rates may stay higher for longer. Today's rates went down, but expected future path went up. And that brings us to the single most important rule of market reactions. Market compare reality with expectations. But every Fed meeting, investors already have a forecast. That forecast is already reflected in prices. Suppose the market expects 5 cuts. The Fed cuts once, and signals that almost no additional cuts are coming. Did rate go down? Yes. Was the news good relative to expectations? No. And that is how good-looking headlines can produce bad market reactions. The question isn't, was this good news? It's actually, was this better or worse than what the market already expected? But how do we know what the market expects? There's actually a market built around future short-term rates. That is now we introduce Fed funds futures. It is financial contracts whose price reveal information about where traders expect the Fed funds rate to be in the future. If traders expect aggressive cuts, that gets reflected in the futures market. If they suddenly expect fewer cuts, those contracts move. So the dot plot tells us something about the Fed's projections. Fed funds futures tell us something about the market's expectations. Now we can compare the two. And when new information forces the market to rebuild its assumptions, there's a name for that too: repricing. Changing asset price because expectations change. If investors suddenly believe future rates will be higher than they thought, they don't wait 6 months. They update the calculation today. Bond price change, treasury yield change, stocks change, currency change, real estate valuation can change. Everything gets repriced around the new forecast. Now replay December 18th. The Fed cut by 0.25%, but that cut itself was widely expected. It wasn't a surprise. The surprise was the future. The Fed's updated projection indicated fewer rate cuts ahead of markets had hoped, while inflation remained a concern. So the expected path of interest rates shifted higher. Bond investors repriced. Treasury yields rose. Stock investors repriced. A higher expected path for safe rates meant stronger financial gravity, so future profits became less valuable today. Stocks fell. Currency traders repriced. Higher expected US rates made dollar assets relatively more attractive. The dollar strengthened. And now Sarah's mortgage makes sense too. The Fed lowered an overnight rate. Sarah wanted a 30-year mortgage. Those rates live in different parts of the system. The Fed moved today's short-term starting point down, but markets revised their view of the long-term future upward. So longer-term yields did not have to fall. Mortgage rate did not have to fall. Nothing was broken. The system was behaving exactly the way we have now learned it behaves. The Fed moved today's starting point. Markets changed their forecast for tomorrow, and the forecast mattered more. That's how a quarter-point decision can move trillions of dollars, not because a 0.25% itself is enormous, but because 1 million can change the expected price of money for years into the future. So the next time the Fed announced a decision, don't stop at, did it raise or cut? That matters, but it's only the first question. 1. What did the Fed actually do? Raise, cut, or hold? 2. What does the Fed think happens next? Look at the dot plot. Listen to the statement. Listen to the press conference. Did the expected path move higher or lower? 3. What is happening to inflation and employment? Because those are central to the Fed's dual mandate. Watch CPI, watch PCE, watch core inflation, watch labor market data. Not because the numbers are exciting by itself, but because they influence the next Fed decision. 4. What is the bond market saying? Are treasury yields rising, falling? What is happening to the yield curve? Remember, stocks tell you a lot about expected company profit. Bonds tell you a lot about the expected future price of money. And because the interest rate feed into almost everything, the bond market is often worth watching first. And almost importantly, what changed relative to expectations? What had the market already priced in? Was the Fed more hawkish than expected? Or more dovish? Did inflation surprise? Did the future path change? Because markets do not simply move on events, they move on surprises. And once you understand that, financial headlines start sounding different. The Fed cuts rates, okay. What happened to the expected path after the cut? Core inflation came in hot, okay. What does that imply about future Fed policy? The 10-year Treasury jumped, okay. What changed in the market's view of inflation and future rates? The market repriced. Now you know what that actually means. And now, that brings back the picture from the beginning one final time. At the beginning, this looked like a mess. Now we can read it. Start at the Federal Reserve. The Fed sets its policy target and use tools such as IORB to anchor the very short end of the financial system. That influences the overnight markets, the federal funds rate, SOFR, other short-term rates. Then the river branches. The bank branch, short-term benchmarks change, prime moves, SOFR-linked loans move, credit lines change, credit card rates change, saving rates may adjust. Businesses and consumers feel it. Second one, the bond market branch. Investors update expectations for future Fed policy, inflation, growth, and risk. Treasury yields move. Those yields become reference point for long-term financing, corporate bonds, mortgages, other long-term loans. Third one, the asset price branch. Safe returns change. Discount rates change. Therefore, stocks reprice. Existing bonds reprice. Real estate and other assets respond. And then, the financial system reached the real economy. A mortgage becomes affordable or unaffordable. A factory gets built or cancelled. A company hires or waits. A household spends or saves. Millions of decisions change demand. And eventually, growth, employment, and inflation respond. But remember the timing. Financial markets can move the moment expectations change. The real economy takes much longer. That is why Treasury yields can fall before the Fed cuts. Stocks can fall before companies lay anyone off. Mortgage rates can rise after a Fed cut. And markets can celebrate apparently bad economic news, or panic after apparently good news. They aren't only reacting to today, they are constantly trying to price tomorrow. So the Fed controls the spring, market price the future, and the economy fuels the water downstream. The decision can be tiny, the ripple can be enormous. Now you know how the water flows. If you enjoyed this video and want to see more deep dive like this, please subscribe and turn on the little bell icon. If you want to watch new videos in advance, please consider joining the membership. Research team members can also download infographics from my videos. Thank you so much for watching. I will see you in the next one.